In today's episode of the Daily Brief, I'll talk about three interesting stories. I first talk about IndiGo Airlines and how, despite doing well, they are facing a 990 crore loss. I then discuss some interesting details about the conflict between Iran and Israel and the impact of that conflict on crude prices. And finally, I talk about what is happening in India's alco-bev industry. Welcome to the Daily Brief show by Zerodha, where our aim is to simplify the biggest news in the financial markets in a way that's one level deeper as compared to news channels. I'm your host, Lavanya Krishna, and today is the 29th of October. You can find us on Spotify, Apple Podcasts, or wherever you consume your podcast. If you prefer video, you can listen along with interesting charts on YouTube. The Daily Brief is also available in Hindi. And if you like reading instead of watching or listening, you can sign up for our no spam newsletter for a quick rundown. All the links are in the comments. Now let's move on to why did IndiGo post a 990 crore rupee loss despite strong revenue growth? The Indian aviation market is brewing with excitement right now. A large part of it is driven by an expanding middle class and a growing demand for premium offerings like air travel. Right at the center of all of this is IndiGo Airlines, which is India's largest airline with over 60% of the market share. So, as a natural result of it, whenever we look at how IndiGo is doing, we get a good sense of how the overall aviation industry in India is doing. IndiGo recently released its quarterly results, which have been a mixed bag. It has both promising numbers and a few challenges that are weighing down profits. In this story today, let's break it all down and understand exactly what's happening. For the quarter, IndiGo reported a total revenue of 17,800 crore rupees, a 14.6% increase compared to the same time last year. This growth was driven by strong demand and the airline's decision to increase its capacity, which refers to the number of seats available across all flights. IndiGo expanded its capacity by 8%, meaning it added more flights and opened new routes, allowing more passengers to fly with them. Now, an important figure here is the passenger load factor, or PLF. PLF measures how full the flights are on average, and for IndiGo, it stood at 82.6%, showing that most flights were nearly full. Another key metric in the airline industry is yield, which tells us how much revenue the airline makes for each passenger per kilometer flown. IndiGo's yield was 4.55 rupees, which not only beat estimates, but also showed a 2% rise from the previous year. These figures point to a strong core performance. But despite this, IndiGo posted a net loss of 990 crore rupees, which is a big shift from the 190 crore profit it had in the same period last year. So the question is, what exactly went wrong? Key challenges weighing down IndiGo's profits. IndiGo is currently dealing with a set of challenges that are affecting its profitability. Let's break them down one by one to see how they are impacting the airline's bottom line. Number 1, aircraft grounding and supply chain bottlenecks. One of the biggest challenges IndiGo faced this quarter was a high number of grounded aircrafts, over 60 planes. This is a major problem because grounded planes don't make money. They still need maintenance and regular checks, but they aren't flying passengers who pay for tickets. IndiGo's grounded planes are mostly from its Airbus A320neo fleet, a specific model known for its fuel efficiency and suitability for short to medium haul flights. Now, these planes have engines from a manufacturer called Pratt & Whitney, whose engines have lately been experiencing wear and tear issues faster than expected. This means that they need more frequent maintenance, leading to more frequent and longer groundings. And it's not just with IndiGo. Globally as well, Pratt & Whitney and other engine suppliers have been struggling to keep up with the demand for parts, which is creating a backlog in repairs and maintenance. To address the gap and keep its schedule running smoothly, IndiGo had to lease additional planes on short-term contracts, known as ACMI leases, covering aircraft, crew, maintenance, and insurance. These are essentially ready-to-fly planes that come at a premium cost. While these leased planes filled in the gap, they came at a higher price, adding to IndiGo's operating costs. IndiGo CEO Peter Elbers mentioned that they are making efforts to reduce these grounded planes and expect this number to come down to the mid-40s by FY26. But until then, the costs of keeping grounded planes and paying for temporary leases are a burden on their finances. Number 2, rising jet fuel costs. Jet fuel is one of the biggest expenses for any airline, and IndiGo isn't spared from the rising costs here. This quarter, fuel costs rose by 12.8% compared to last year, putting more pressure on the airline's expenses. There are a couple of reasons for this increase. Firstly, global oil prices have been unpredictable, influenced by geopolitical tensions and production cuts by oil producing countries. On top of that, some Indian states recently increased VAT or value added tax on aviation turbine fuel, making it even more expensive for airlines like Indigo to operate flights within these states. The rise in fuel costs is reflected in a metric called CASK or cost per available seat kilometer, which measures how much it costs the airline to operate one seat over 1 kilometer. For Indigo, CASK jumped from 4.19 rupees last year to 4.69 rupees this quarter, driven by the fuel costs, the additional lease expenses, and overall inflation in operating costs. Number 3, inflation in other operating costs. It's not just fuel. Other operating costs are also rising. In fact, Indigo's non-fuel CASK, covering things like airport fees, maintenance, crew costs, ground service, went up by about 17% year on year. A big factor here is the airports across India, especially in major hubs like Delhi and Mumbai, are undergoing expansions to meet growing demand. This has led to higher fees for airlines, which directly impacts costs. Additionally, congestion at these major airports have forced IndiGo to increase block times, which is the time scheduled for each flight, including boarding, taxiing, flying, and landing. Longer block times means more time on the ground and in the air, which can lead to inefficient fuel usage and additional expenses. Inflation is also affecting expenses related to crew wages, hotel stays for crews on overnight flights, and ground handling charges. During an earnings call, IndiGo's management mentioned that inflationary pressures have impacted various line items on their profit and loss statement, from employee wages to ground handling costs. Number 4, competitive pressures and yield constraints. While IndiGo has been facing these rising costs, it is also operating in a competitive market. New players like Akasa Air and the re-energized Air India have been expanding aggressively, making it hard for IndiGo to increase fares without losing customers. In the international segment especially, competition is intensifying, which puts pressure on ticket prices. IndiGo's RASK, or revenue per available seat kilometer, a measure of how effectively the airline generates revenue, grew by 5% year over year to 4.45 rupees this quarter. But with competition heating up, IndiGo has limited room to raise fares. They need to keep fares reasonable to retain passengers, even as their costs keep rising. Despite these challenges, IndiGo is pushing forward with several initiatives to boost revenue and expand its market reach. One major move is IndiGo's foray into the business class segment on key routes, such as Delhi-Mumbai. By offering a premium service, IndiGo is hoping to attract high-value travelers who are less sensitive to price changes. This shift is part of a broader effort to diversify its customer base beyond price-sensitive travelers. Another initiative is the launch of Blue Chip, a loyalty program designed to encourage repeat business and strengthen customer loyalty. Loyalty programs help airlines build a stronger connection with their customers, giving them reasons to keep coming back. IndiGo is also doubling down on its international expansion. The airline has been adding new routes to destinations like Malaysia and Sri Lanka and aims to have its international flights make up 30% of its total capacity by year end. This international push is key for IndiGo as it faces intense competition domestically and seeks new revenue sources outside India. In a forward-looking move, IndiGo recently launched IndiGo Ventures, a venture capital arm with an investment fund of 30 crore rupees, aimed at supporting startups focused on aviation innovation. This could not only bring new technologies to IndiGo, but also position the airlines as a forward-thinking leader in the industry. IndiGo's challenges aren't going away overnight, but the airline is optimistic. It plans to reduce the number of grounded planes significantly by FY26, which should also help lower costs associated with temporary leases. There is also hope that global oil prices will stabilize, which could ease the pressure of rising fuel expenses. Indigo's story this quarter shows the complexities of running a large airline in a fast growing but competitive market. With rising costs and the need to stay competitive, Indigo is taking steps to adapt, expand, and stay ahead. It's a balancing act, and only time will tell if their strategies will help turn these headwinds into tailwinds for future profitability. What is happening in the alcohol industry? India's spirits market is unique. While globally alcohol consumption is often split across beer, wine, and spirits, Indian consumers overwhelmingly favor spirits, primarily whiskey, rum, and brandy. Spirits make up nearly 90% of all alcohol consumed in India, with beer a distant second and wine barely visible. This creates a vast market for companies like United Spirits Limited or USL, part of global beverage giant Diageo, and Radico Khaitan, one of India's leading homegrown players. When these companies release quarterly results, they reveal more than their own progress. They offer a close-up on the state of India's spirits industry. USL's shift towards premiumization, for instance, isn't just a company direction. It reflects a broader trend in Indian drinking culture. Radico's focus on luxury and semi-luxury brands signals that the demand for high-end spirits is extending beyond a small elite to a wider audience. By looking at USL and Radico Khaitan's recent quarterly result, we gain insight into where India's spirits market is headed and the factors driving its evolution. But before I get into that, let me quickly explain the two things that often pop up in the alcobev industry: prestige and above, and popular. In the Indian spirits market, the popular segment focuses on high-volume, affordable brands, while prestige and above targets premium, higher-margin brands for consumers willing to pay for quality. The prestige and above, or the P&A segment, reflects a growing trend towards premiumization, which has become a cornerstone for companies like USL and Radico Khaitan. United Spirits had a challenging Q2 of financial year 25. The company's net sales value, or NSV, dropped slightly by 0.8% from the previous quarter, landing at 2,844 crore rupees. Performance in its key prestige and above, or P&A segment, which makes up 88.9% of NSV, was flat, showing no growth from Q1 of FY25. The popular segment, contributing the remaining 11.1%, also saw minimal change. Despite United Spirits' focus on premiumization, this quarter showed that even high-end brands couldn't drive growth, highlighting the pressures the company faces in a tough consumer environment. But why was there no growth? The management on the earnings call said that this was due to a weaker consumer demand that affected premium sales, and noted that growth has been slower than expected across the board, particularly for premium brands. But the company's CEO Hina Nagarajan also highlighted a major development: the resumption of operations in Andhra Pradesh after 5 years. Andhra Pradesh was a sizable market before regulatory issues forced an exit, so this return is expected to provide a boost. Nagarajan remains optimistic about the upcoming festive season and the strength of USL's premium portfolio in driving future growth. Now coming to Radico. Radico Khaitan earns 31.6% of its revenue from selling bulk alcohol to other manufacturers, or B2B business, which grew 55.9% year over year thanks to full utilization of their new Sitapur plant. The remaining 68.4% comes from its branded liquor business, IMFL, where the company has strategically focused on premium brands. Their focus is evident in their IMFL sales mix. Premium brands, or prestige and above, contribute 75.7%, while popular brands make up 24.3%, showing strong execution of their premiumization strategy. Radico's PAT stood at 82.2 crore rupees, supported by the strong performance of its high-end brands, including the Rampur Indian Single Malt and the recent Rampur Jugalbandi series. The company's strategy also includes expanding internationally, with plans to introduce its Indian single malts to markets like the US and the UK. These moves aim to capture the rising global demand for Indian origin premium spirits, positioning Radico Khaitan as a key player in both domestic and international luxury markets. Both USL and Radico Khaitan's results underscore a broader industry trend. Growth is being driven almost entirely by the prestige and above segment. While the popular segment remains important for overall volume, it no longer contributes as significantly to revenue growth. Instead, Premium products are increasingly where companies are finding their financial gains. As younger, urbanized consumers show more interest in quality, both companies have prioritized this segment to meet changing preferences. So the question we must ask is, can India's spirit giants keep growing by going premium? Or will they need to revive their mass appeal? Why did oil prices drop after Israel struck Iran? We need to talk about what happened over the weekend between Israel and Iran because it's causing some drama in the oil markets. And if you're in India, like me, this matters a lot since we import nearly 90% of our oil. Let me first break down the increasingly dangerous game of tit for tat between Israel and Iran that's been escalating all year. It started in April when Israel struck the Iranian consulate in Damascus, killing 13 people, including a top Iranian commander. Iran responded with its first ever direct attack on Israel, launching about 300 missiles and drones. Then things got even more intense. In July, when a Hamas leader was killed in Tehran. In late September, Israel assassinated Hezbollah leader Hassan Nasrallah and an Iranian general in Beirut. Iran retaliated on October 1st, launching about 180 ballistic missiles at Israel. And now, this past weekend, Israel struck back. Early Saturday morning, Israeli jets hit multiple targets across Iran, including military installations in Tehran, Ilam, and Khuzestan provinces. While 4 Iranian soldiers were killed, here's what's interesting. Israel deliberately avoided hitting Iran's oil facilities or nuclear sites. And this is where it gets fascinating from a geopolitical perspective. According to reports, the Biden administration worked closely with Israel to ensure a targeted and proportional response. This isn't just about minimizing escalation, it's about protecting the global economy. The White House specifically urged Israel not to target Iran's oil infrastructure or nuclear facilities, knowing full well what that could do to global markets. Now, this measured response is exactly why oil prices plunged by about 6% when markets opened today. Brent crude dropped below about $72 a barrel and WTI is hovering around $67. Markets had been pricing in a much more aggressive strike that could have disrupted Iranian oil supplies. When that didn't happen, traders started unwinding what we call the war premium in oil prices. Here's why we can't breathe easy just yet. The biggest risk isn't just about Iran's oil production, it's about the Strait of Hormuz. This narrow waterway between Iran and Oman is basically the world's most important oil choke point. In 2022, about 21 million barrels of oil passed through it daily. That is roughly 21% of global consumption. If this conflict escalates into a full-blown war, Iran could try to block the strait. Let me put this in perspective. About 82% of the crude oil passing through Hormuz goes to Asian markets. China, India, Japan, and South Korea are the top destinations, accounting for 67% of all flows. So if anything happens to the strait, Asia gets hit first and hardest. Yes, Saudi Arabia and the UAE have pipelines that bypass Hormuz, but they can only handle about 3.5 million barrels per day. That's nowhere near enough to replace the current flow. And while Iran has downplayed the weekend attacks, their foreign minister has indicated that any response would be proportionate and calculated. That's diplomatic speak for "we're not done yet." You know what's fascinating? The markets are telling us that they think this might be the end of direct strikes between Israel and Iran. But in my experience covering oil markets, it's exactly when everyone gets comfortable that we need to stay most alert. Remember, we're heading into a US election year, and historically, that's added another layer of uncertainty to Middle East dynamics. If you're tracking oil prices, keep your eyes on 2 things: any signs of Iranian retaliation, and more importantly, any threats to the Strait of Hormuz. Now let's move on to our final section, the tidbits for the day. Number 1. Wyatt Ventures, Aramco's venture capital arm, is injecting $100 million into artificial intelligence startups as a part of Saudi Arabia's Vision 2030 plan. The initiative, overseen by experts from Meta and Amazon, aims to establish Saudi Arabia as a top 15 country for AI. Number 2. Wari Energies Limited, India's top solar panel manufacturer, saw its shares soar 75% above the issue price following a $514 million IPO. The offering was subscribed over 70 times, attracting major Wall Street investors like Goldman Sachs and BlackRock. Number 3. E-commerce giants Flipkart, Amazon, and Meesho are making substantial inroads into rural India, launching new fulfillment centers and creating jobs. The platform saw strong festive season demand from over 2,800 small towns, with non-metro cities driving 75% of smartphone sales. Number 4. City gas distribution companies face increased costs due to reduced APM gas allocation, leading to an expected CNG price rise of 2 to 3 rupees per kg. The fuel will still remain more economical compared to petrol and diesel.
Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.